In recent times, a growing number of young people are finding it increasingly difficult to purchase a home in their lifetime. Simultaneously, the cost of homes continues to rise annually. This raises the question, how can homes become more expensive when hardly anyone can afford to buy them? The concept of saving up for a 20% down payment appears almost unattainable. Rental rates are soaring, sometimes increasing suddenly by a significant percentage without prior notice. The importance of a family home in one's financial life is undeniable. It not only provides a place to live, but also allows individuals to build equity in a property they can eventually call their own. Having a 30-year mortgage for homeownership is often more cost-effective on a monthly basis compared to renting in many cities. If you can manage to purchase your own home, it can lead to increased wealth, both in the present and the future. According to a report from Redfin, only 21% of homes put up for sale in 2022 were considered affordable, a sharp decline from the 60% figure seen in 2021. This means that within just 1 year, 2/3 of what was considered affordable housing became out of reach for the average American. With this housing conundrum in mind, let's explore the elements that make owning a home feel like a distant dream for numerous individuals. A survey conducted by a dedicated team revealed that housing affordability has reached an all-time low in history. But what's the end game in this scenario? If people can't afford homes, shouldn't house prices stop increasing? The reality is quite the opposite. There are 3 compelling reasons why this situation might worsen before it gets better. Firstly, houses don't necessarily need to be affordable for people to buy them. This may sound counterintuitive, but there is an entire industry working to make it possible. People save money for a down payment. Wages have not kept pace with rising home prices, and a 20% down payment grows much slower in absolute terms, allowing individuals to enter the housing market despite the disparities. According to Zillow, the average home sold in America traded for $230,000 in 2020. However, at the beginning of 2023, the average home price had skyrocketed to $330,000, a significant $100,000 increase in less than 3 years. Forbes reports that the average American earns a salary of $59,000 before taxes. After federal tax and FICA deductions, the take-home pay is approximately $49,000. Even if this average person managed to save a remarkable 70% of their take-home pay to buy a home, they would still find themselves no closer to their goal after 3 years, because home prices increased at a rate similar to their savings. While it's true that the average home's value aligns with the average person's earnings, most individuals save solely for a down payment. Thus, the 70% savings rate becomes 14% or 7% in the case of dual-income households where the other partner also earns the average salary. This is still a significant savings commitment, especially when considering that 57% of Americans can't afford a $1,000 payment without incurring debt. It's crucial to acknowledge that this saving rate is only sufficient to keep pace with escalating home prices, without actually bringing buyers closer to their goal of homeownership. Lenders and banks, who have a vested interest in real estate, recognize the challenges faced by families, particularly those struggling to afford food, rent, and other essential expenses that are outpacing wage growth. As a result, they have shifted their criteria. According to the National Association of Realtors, the average down payment for first-time homebuyers is a mere 7%, while repeat purchasers, who have had the opportunity to build equity in their previous homes, typically put down just 17%. This means that even with a minimal deposit, house prices can escalate to many multiples of one's income before becoming unattainable. For individuals who find even a 7% down payment challenging, Zillow recently introduced a 1% down payment loan product. With this offering, buyers contribute a 1% down payment, and Zillow provides an additional 2% at closing, which is considered a grant and doesn't require repayment. While homes are appreciating faster than the average person's income, the cost of entry is being reduced swiftly. However, it's important to remember that the down payment is just one part of the equation. Borrowers still need to manage the ongoing repayments. If affording a 20% down payment seems out of reach, it's time to gain a better understanding of financial principles to determine if this housing situation can be sustained indefinitely. Houses can continue to appreciate in value even when very few can afford to buy them. This paradox arises because there's a scarcity of sellers in the housing market. People are not rushing to put their homes on the market just because they have a 30-year fixed-rate mortgage below 3%. At present, there's a distinct lack of interest in selling homes, despite many people wishing to move. In fact, home sales in the United States have reached their lowest levels in a decade, even with a growing population. In 2021, 6 million homes were sold, but now the annualized rate has dropped to only 4 million. Potential sellers with existing home loans are hesitant to sell because the rental market has become even less affordable. Furthermore, moving to a new home would mean securing a new home loan with significantly higher interest rates than their current mortgage. This has led to an increase in competition for rental properties, as the cooling housing market has caused people to stay in rental accommodations for more extended periods. As a result, the supply of homes for sale remains constrained. Many individuals moved during the COVID pandemic, and another move so soon would be disruptive to their social and family lives, not to mention the significant interest expenses associated with new home loans. On average, homeowners stay in their homes for 13.2 years. After a period of heightened home buying activity over the last 3 years, more Americans are now settling into their new homes for more extended periods, leading to a reluctance to sell. New buyers are also delaying their home purchases, waiting for interest rates to decrease. Additionally, the average number of people living in a household has increased for the first time in 160 years. This is due to a shift away from smaller families and individuals choosing to stay with their parents for more extended periods to avoid the challenges of living in an unaffordable housing market. While the housing market remains active, regular buyers and sellers are opting to wait until entering the market becomes more affordable. There are 3 key groups still active in the market. The first group consists of all cash buyers who have capital from the sale of their previous homes and wish to purchase new ones. For example, individuals who bought homes in the 1970s for a modest sum and now want to downsize are taking advantage of the current high prices, enabling them to live off the surplus cash from selling their larger properties. The second group comprises people relocating to different states. The high cost of housing in expensive cities is driving people to seek more affordable areas, even if they have jobs that can be performed remotely. People often prefer to stay close to friends, family, and familiar amenities, even if it means living just 18 miles from their hometown on average. The third group consists of investors, primarily interested in the return on their assets. Despite the higher interest rates they face when financing property purchases, they are still benefiting from high rental incomes. Real estate investment purchases experienced significant year-on-year growth in 2022, and institutional investors, particularly real estate investment trusts, REITs, have become increasingly involved in the market. REITs, which operate much like index funds for real estate, have shifted their focus from commercial properties to residential properties, catering to those who cannot afford to purchase homes. Some individuals are investing their savings in REITs to gain exposure to the residential real estate market and ensure their savings keep pace with rising home prices. However, this situation is not sustainable over the long term. The housing market is undergoing changes, and investor purchases have notably slowed down. In certain cities like Las Vegas, Austin, Miami, and Houston, institutional purchases have come to a complete halt. Concerns have been raised about the overvaluation of the system, exemplified by the private equity company Blackstone blocking investor withdrawals from its $71 billion fund earlier this year. If investors rapidly withdraw their funds, this may force investment managers to sell properties, further driving down prices. It's essential to keep in mind that these dynamics may not significantly affect those who own shares in a REIT, as they can easily liquidate their positions by selling their shares to other investors without requiring the assets themselves to be liquidated. Additionally, affluent families are now more successful in retaining multiple properties for themselves. leading to the emergence of a new era of dynastic wealth, where family legacies can endure for centuries. Certain American billionaires have already reached this status. In conclusion, the real estate market is a complex puzzle, and understanding its dynamics is crucial in today's ever-changing landscape. With skyrocketing home prices, seemingly unattainable down payments, and shifting market trends, the path to homeownership may appear challenging. However, knowledge is the key to making informed financial decisions. If you've made it to the end of the video, a big thanks to you for hanging in there. Your dedication is truly appreciated.
We'd love for you to be part of the Filthy Rich community.
Hit that subscribe button and give us a thumbs up to stay in the loop for more friendly advice on personal finance, investing, and building your wealth.